back to Your Business Unleashed, the podcast where we help entrepreneurs turbocharge their businesses, unlock the strategies, insights, and stories that they need to thrive. Of course, I'm your host, Clayton Achen, and today's episode is going to zero in on a cornerstone for business owners considering transitions, which is valuations. Okay, so valuation isn't just putting a number on your business. It's critical for tax planning, for succession. There's some family law stuff, deal negotiations. Maybe you're selling your business. Maybe you're looking for private equity. Here to help us unpack all of this are three distinguished guests. We got Rob Worthington, a partner at MLT Aikins in Calgary. Rob has deep expertise in tax, reorganizations, some family succession, estate planning, and even we kind of sideswipe on family law scenarios a little bit where fairness needs proof. He was called to the Alberta and BC bars and holds an LLB and BCom from the University of Alberta. He's a STEP certified in trust and estates and regularly presents at institutions like the Tax Executives Institute and the Society of Trust and Estate Practitioners. Welcome, Rob. Thanks for being with us.
Thank you.
Yeah.
Pleasure to be here.
We got Mark Mielke. Am I pronouncing that right, Mark?
Yeah, you got it, Clay.
Yeah, welcome. Mark's a partner at MLT Aikins as well in Calgary, and he specializes in M&A, mergers and acquisitions, corporate finance, and securities. He works across industries, including tech, cannabis, energies, life sciences, transportation, deals ranging from $1 million up beyond $100 million. He was educated with a JD from Dalhousie, Master of Science in Urban Economic Development at UCL and a BA in Economics from the University of Alberta, and he's been recognized as the one to watch in securities law by Best Lawyers in Canada. Welcome, Mark. Thanks, man.
Thanks.
I appreciate you being here. Gord has been with us on a couple other podcasts. He's the president of McFarlane Transition Advisors, where he leads the M&A advisory, business valuations, and transition planning for our group here at Aiken Henderson. He spent a lot of years at Grant Thornton, where he actually hired me out of university. Thank you, Gord. I appreciate that very much. And he worked with FYI doctors for a lot of years, oversaw hundreds of acquisitions of clinics nationwide. And he's also a respected leader in the valuation profession, having served on the board of CBV and chaired their professional practice and standards committee and served on the International Institute of Business Valuators on the executive board. Thank you, Gord, for being with us.
Great to be here.
Right on. So, okay, valuations. I think that we've got a couple really useful but that introduction was verbose and you all have extremely impressive resumes. But to break it down, Rob's a tax guy, right? Mark's an M&A guy, right? And Gord is also an M&A guy, but he's an accountant. The other two are lawyers. And Gord sort of does the valuations. Rob and Mark use the valuations. So it's a really cool mix of people that we have on this call. And we're going to figure out for our clients, for people who own businesses, why do valuations matter? And, the first part is really with regards to tax. So we're gonna kick it off with you, Rob, and talk about the types of things that you do with valuations and where you need them from a tax perspective. So why don't you start talking, I guess, from a compliance and strategy perspective and why CRA needs valuations?
Sure. Yeah. So it's usually driven by some sort of an event. So there's a family succession plan, passing a business on to the next generation, or an estate freeze, like you're doing a strategy to push future growth of your company into a family trust, or a split up of a business. Unfortunately, if there's a divorce or a spin out of assets because you want to move your real estate out. So there's some sort of an event that drives it, and one of the things I find, I'm just going to say right off the bat, because I hear this a lot, clients say, why do I need a valuation? Like, why do I need to spend the money? And the answer is usually because the CRA requires you to make reasonable efforts to ascertain the value of your business if you're doing something like a business succession plan, an estate freeze, a divisive reorganization, like a butterfly, we call it. We call it a butterfly because when you draw it on a piece of paper, this reorganization looks like a butterfly. So those are the types of scenarios where we would need to get a CBV, a business valuator like Gord, involved.
Right. And so if we just think about this for a second, why does CRA care? Right? Like, why would CRA care about having a proper valuation done. I guess there's two different types of scenarios here where folks might transact, right? If I'm transacting with you, you're not my brother, you're not even my uncle, right? We're totally unrelated. And if I sell my business to you, whatever we agree on, because we're not related, is fair market value. So we don't need a valuation. We've just valued it by way of agreeing on a price between two unrelated parties. How does it get muddied in the related party context? So explain that a little bit and where the offenses might lie.
Yeah. So great question. Here's the mischief. If I'm dad and I own a business and I want to pass the business or some of the growth onto that business onto my daughter, okay. Canada doesn't have a gift tax, but it's got something similar to that. Like, I can't just give the shares of my company away to my daughter or some portion away to them, right? There's going to be a capital gains tax on that. And so tax planners use something called an estate freeze to avoid the capital gain. But if it's not done correctly, the CRA will look at that and say, well, if you undervalued your business when you do the estate freeze, it's kind of like you gave it away. And so we're going to assess a capital gain on that. So it's sort of a notional benefit because Canada doesn't have a gift tax, but it's got a capital gains tax, and you can't just give your business away to the next generation, for example. So that's what the CRA is worried about. Like I've seen this happen. So that's the context, and that's right. The mischief.
So I guess in our tax system, when you give something away, you're deemed to have disposed of it, in fact, and when you're deemed to have disposed of it to a related party, such as your daughter, you're deemed to have disposed of it at fair market value. And you go, okay, well, great. I think that fair market value is $100. And the CRA goes, well, no, your business is actually worth $10 million. Mm-hmm. And I want to charge you tax on that growth. You paid $1 for your company originally. It's worth, maybe you got $1 on your balance sheet, and now it's worth $10 million. Well, you need to pay $2.4 million in tax on that transaction, give or take. Yeah. And you can't just give it to your daughter and avoid paying that tax because you gave it to your daughter. And what you'd be doing is conferring a benefit on her. And because you're related, not unrelated, like me and Rob, that's a taxable event, and I want my pound of flesh, basically, right?
Yeah, exactly. Yeah. And don't think that your business is small potatoes. Like, don't think that. Like, you gave the example of, the extreme example. It's not worth $1. It's worth 10 million. Come on. Okay. But I've seen the CRA get excited about less extreme examples. For example, the owner thought the business was worth $1 million, and in fact, it was worth 1.5 million, and the CRA had some reasonable basis for that, right? Normally, we cover off that risk with a price adjustment clause, and which says if the CRA comes along and says, you know what, it's not worth $1 million, it's worth 1.5. Then this price adjustment clause kicked in, and the value of the preferred shares is adjusted. So there's mechanisms. But in order for the CRA to respect that price adjustment clause, you have to make reasonable efforts to determine the value. Right. Well, what's reasonable efforts? Is it, in my industry, they sell at 3 times, 3x, 2.5x. Gord, what do you think? I mean, multiples, do you think that's valid, or do you got to do a deeper dive?
Yeah, I mean, it drives me crazy, to be honest, hearing people bandying about multiples without any idea of, the underlying business. They've heard multiple bandied about at coffee, cocktail circuit, whatever. And quite often you're comparing apples to oranges, right? No businesses are identical, and so uniqueness, just using that EBITDA multiple doesn't really capture the uniqueness of the business.
Yeah, why? Because there's adjustments to EBIT. Like you gotta back out abnormal things, add in normal things. What would a reasonable buyer expect out of a reasonable business? All this, right?
100%. It's cash. Is it 100% cash on the terms? Is it earn out over time?
Yeah.
All kinds of different factors.
Yeah. If the owner paid himself $100,000 salary or a $500,000 salary, that affects earnings, right?
Yeah. And so, bringing it back to this idea that, listen, I'm going to transfer my business to my daughter. I mean, it's a good example. So let's just keep wrapping on that for a second. And I have an unrealized capital gain on these shares that I paid $1 for originally. Now my business is worth, let's just say 10 million. And I want to get my children involved in the ops of the company and have them involved in the ownership of the company. Well, there's a transaction that you can do where you can freeze the current value, the current 10 million, and you can do a tax move as long as it's properly valued and there's a price adjustment clause. And the price adjustment clause, as we've discovered, only hangs if you've arrived at that valuation using reasonable means and methods, which for all intents and purposes means you're acting in good faith with the CRA, I would say, that's basically what that is. And which we can now define to say, a CBV report's a pretty good measure of that valuation. And so I don't want to pay tax on $10 million. Well, why? Well, guess what? I haven't sold my shares, right? I haven't actually sold anything. My daughter doesn't have $10 million to give me. And so we're deferring that to later when the sale actually happens, but we are locking in that value in my hands for later. So that when a sale actually comes, or when my now daughter's company has the ability to start buying me out, I will start paying tax on that frozen $10 million, right? That's what we're talking about here. And so we want to be able to engage in a transaction where the CRA would otherwise say, I want my pound of flesh on the 10 million right now. And we're going, whoa, I don't have that cash. I haven't sold anything really for cash. So we need to kick that can down the road a little bit. So Rob, do you have any tales from the crypt of where you've executed a transaction and maybe the client says, yeah, whatever, that value is good enough, and you've done, followed their instructions and it's just blown up in your face? Do you have anything like that?
Yeah, I do. And you know what? When I think about it, it wasn't really an aggressive or abusive situation. So this was a client who had a somewhat successful business, not huge, it was worth, it was actually about the numbers that I gave earlier. It was worth about $1.5 million, and there was a valuation actually. Believe it or not, there was a valuation of sorts for $1 million. But it wasn't done by a CBV. It was done by a business broker, and it was a few months old, and it didn't take into account the redundant assets. So there was a condo in the corporation as well, and that should not have been included because it was held in a separate company, and so there was a receivable from that separate company. But anyway, if Gord had looked at it, he would have dug into it and said, well, of course, we got to not include the redundant assets for the value of the business, right? And so we did an estate freeze, and the CRA came back and reassessed, and the accountant filed a notice of objection and said, well, hey, price adjustment clause, no problem. You say it's $1.5 million, fair enough. There you go. Those preferred shares that you mentioned earlier, Clayton, they're just adjusted to $1.5 million. And the CRA said, well, we're not going to respect the price adjustment clause because we don't think you made reasonable efforts. The valuation was one that you didn't pay for, and it didn't account for the redundant assets. Okay, fine. So we've filed an appeal to the Tax Court of Canada, and I settled it with the Department of Justice. So it all turned out fine for the client. But here's the thing: when clients say, "Well, I don't want to pay $5,000 or $10,000 for a valuation," there's a part of me inside that says, okay, great. Pay me $50,000 or $100,000 to
go to
fight
appeal
the tax dispute later on.
Yeah,
but is that a good result for the business owner?
No.
So and the thing is, so it's a pretty cheap insurance policy. And you know what? There is some intangible value to getting an independent view of what your business is actually worth. And, Mark can talk about this on the M&A side and so on, but there's some value in having a valuation beyond just the audit risk and the tax risk.
Yeah, right on. Well, and maybe that's a really good segue to bring Mark into the conversation, right? Is to talk a bit about we're doing some M&A, we're setting realistic expectations. Where do you see valuations come into play, and why are they so important on your side, Mark?
Yeah, thanks, Clay. Well, there's a few different reasons why valuations come into play on the mergers and acquisitions side of the deal. Both if you're in the gearing up to acquire a company, or if you're gearing up to sell your company, there's benefits on both sides. So I'd say that the first part, and Rob and I typically advise clients, if you're looking to sell, the corporate and tax planning to prepare to sell your business, it should take place 2 to 3 years before the sale. So
Right.
If you're looking to retire at 60 or 65, you need to be calling Rob and I, when you're in your late 50s, so we can begin this tax and corporate planning process to help you maximize the value you get from your business, and also maximize the tax efficient strategies that we can apply on sale, to help you bring home more cash for the business that you've worked so hard to build.
Yeah, for sure. We've touched on that actually in a previous episode. Is like, if you get to sale day and you haven't structured the business properly, we've got a whole episode on your lifetime capital gains exemption. We're not going to get into that. I think we might actually have a couple where we touch on it. But I think from a tax perspective, that's really the light at the end of the tunnel. You want that. And the opportunity to multiply that. And that's going to happen years in advance. And you want to prepare your business operationally as well. So that's a really good point, Mark.
Yeah. So we get the valuation where we're looking to sell in a few years. We get Gord in, he does the valuation. That valuation is going to help us understand the key drivers of the valuation of the business and the key weaknesses. And that is valuable because that gives you a few years to enhance those key drivers and address those key weaknesses. So if you get your valuation, you understand that your strengths are a loyal customer base, maybe some barriers to entry in the market, really good marketing. You know how you can focus on those to continue to drive that valuation up. Similarly, if the valuation shows some weaknesses that you think a potential purchaser is going to latch on to, or it might deter a potential purchaser, maybe you have really high customer concentration. By getting that valuation a few years out, you're sort of geared up to address those strengths and weaknesses in the coming years, with the idea and the goal of ultimately obtaining a higher valuation and higher exit price a few years down the road when we do that exit transaction.
Yeah.
Somewhat related is when you have that valuation, you can set your KPIs or your key performance indicators over the next few years to align your corporate strategy with the key KPIs that are driving your valuation. So they kind of help you first understand what's driving the value of the business, and then provide a strategy for growth or to enhance that value over the next few years as you gear up for a sale.
Yeah, let's wrap on that for a minute, because I think Gord might have something to say on this. Like, what you're talking about here is, I want to sell my business, and in order for me to sell, most business owners that I know and interact with they are so emotionally invested. They're so, like, their business is like another child to them, right? Just like me, like, this is my baby. And you go, it's hard to step back sometimes and just go, what does somebody maybe want to buy? Do they want to buy my sort of workaholic, 20 hours or 60 hours a week type of thing to keep this thing afloat? Are they after my marketing? Are they after my client list? Like, what exists in this business that might be worth buying? And how might a buyer view that? Gord, I mean, you do that stuff all the time, right?
Yeah, it's interesting, and Mark's touched on it. The valuation can be a starting point for a whole process of growing your business and accelerating the valuation over time. I love the fact that you mentioned, the advanced planning, because quite often in M&A, you're brought into a situation, and boy, you wish you'd and brought in 2 years earlier because there's a whole bunch of issues there. Clay, you mentioned sort of the aspect of personal goodwill. What are you actually buying here? We see it often in medical practices where, the doctor's the practice, and it's really hard to actually get value for that practice. So if you've got a couple of years, you can build a team around that doctor, make him less important to the business, so to speak. Have some associates come in, things like that. So all those things can be built into a valuation process. So we kind of do a benchmark, valuation at inception, and then you use those KPIs, those tools, do an assessment of the business. What's the strengths, weaknesses, opportunities, and threats, etc. And really build out a plan for them to get to where they need to get to. Yeah. At the same time, as you mentioned earlier, the lifetime capital gain exemption I've seen several times where just couldn't get there because they brought in too late, right? You got the 2-year rule, etc.
So, Mark, what's going to increase if I've got like, just broadly speaking, if I'm out shopping for a business, you're in the M&A space, like, what do I want, broadly speaking, and what are going to be the key things that increase my appetite to spend more money? Because as a seller, as an entrepreneur, I've grown a business. I want to maximize my exit. Like this is my retirement fund, right? And so how do I get the most? And so what are you seeing in an M&A space from the types of things that really drive business value?
Well, revenue is the ultimate driver of business value in the M&A space, but the valuation can support that in a more sort of substantive or nuanced manner. Okay. And Gord mentioned a few moments ago that he doesn't like valuating based on multiples, and I agree. And unfortunately, you see lots of deals come in with a valuation based on a multiple, and how that sort of often works itself out once you get into the negotiations is that a potential purchaser, if the valuation is strictly based on 3 times EBITDA, 5 times EBITDA, as part of the purchaser's due diligence, they're really going to start to dive into that EBITDA multiple, and then negotiations can come from there. So as an example, I recently had a transaction. It was based on a multiple. It said right in the LOI, we're valuing your business at a X multiple. Fine. Because that's in the LOI, it's sort of hard for me to negotiate away from that because we've sort of determined a formula already at this stage. The purchaser then, in the course of their due diligence, dives into the EBITDA a little bit. And they recognize that in this instance, the business that I was selling was renting a building from a related party rent-free. Very typical owner-operated business. We got a different holding corp owning the building, no problem. But the purchaser wasn't buying that building. So after the transaction closed, they were going to have to make rent payments. Well, all of a sudden, the EBITDA multiple that we were selling the business based on is not going to be the go-forward EBITDA multiple because we're going to have additional expenses. So that triggered a renegotiation of the multiple and the purchase price as a whole because we had to introduce the concept of adjusted EBITDA. That cuts both ways. And and
time kills deals, right? The more wrenches you throw into a deal, the less chance there is of that deal closing. Period.
100%. And in this example, so we got these lease payments going out. That's going to be a downward adjustment. The sellers were then, well, hold on, our kids all take a salary. That's not going to be here going forward. So we need to get an upward adjustment for that because those salaries aren't going to be impacting EBITDA. And the negotiations then just went very detailed from there would probably be the most granular way to put it.
You've lowered trust.
Mm-hmm. And the quality of earnings and the EBITDA was scrutinized by both parties. And on the basis that we had decided on a formula, and it turned out that formula probably wasn't the best estimate of the value of the business once we really drove into it.
Mark, that all makes a lot of sense. And so using comparables and multiples and sort of market benchmarking is a thing, but as businesses are complex, sort of moving, living things, and they all operate a little bit differently. And if you do something that is, that a buyer might not do, maybe that changes the valuation perspective and changes the negotiating strategy. And as soon as we sort of derail from our LOI or deviate from our LOI or the original intent of the deal, now there's maybe reduced trust and extra negotiating, and all these things have the potential to derail your deal. And by the way, dear customers, you're paying these guys lots of money all along the way to get through this. And if a deal, I've had plenty of deals blow up where you're 50 or 100K into professional fees, and for nothing, for what it ended up being nothing. But you know what? You still got to pay people to work through to get to that point. And so if we do a bit of preparatory work using a valuation as a business or as a baseline and work on it for a few years, your chances of all that happening are greatly diminished. There's a new thing on the market that I want to talk about. It's not really a new thing, but there's some new legislation with regards to employee ownership trusts and ESOPs and whatever. I don't know if we're going to get into the employee ownership trusts in this segment. I got another podcast scheduled for that. But I think that we need to talk about ESOPs for a second. I understand that that's an area that you deal in, Mark. So can you shed some light on how valuations are used in the context of ESOPs, employee stock option plans?
Yeah, absolutely. So employee stock option plans, employee equity plans are a great tool for really any business. They're used a lot, particularly here in Calgary and in Alberta. In the tech industry, you see them in oil and gas also. And I'll talk particularly in tech because that's where stock options are really your bread and butter. And just a quick background on stock options, especially for tech startups. Stock options are a powerful tool in attracting talent, especially when you perhaps can't offer the same salaries as some of the large corporations that we have in Calgary. So you're trying to attract talent, you're trying to attack those top computer scientists and engineers, but how do you match the salaries that the mega firms are paying? You do that with in part with your employee stock option plan. So
right.
The idea behind an employee stock option.
Hold on one sec there. I just want to jump in and say I've got a great client who was he was just making a little bit of salary being a tech guy at a food delivery place, right?
Oh,
and great client, right? And then COVID hits. And what happens to these shares that were worth nothing before, right? They went through the roof. Right. And fortunately, he was in a publicly traded space. But originally, when he got his first tranche, it was not publicly traded. They IPO'd during. And I think that's the hope with a lot of these employees is, listen, I'm going to dive into this private company. I'm going to accept a little bit less pay. Right. Yeah. And maybe we'll IPO and maybe, COVID will happen and the stock price will go through the roof because everybody's ordering food to their door. So that's a practical example of what's happened with an ESOP. I think companies that are not well positioned for an ESOP are ones that have no hope of their equity value increasing in the future. And so when my clients ask me about ESOPs, there is a real target market for that. And I think you're right that the tech industry is that it's right in there. So sorry to interrupt you, but.
No, that was great background. And as you point out, the whole idea is that you grant your employees stock options at a certain strike price on day one. And then as the value of your shares grow over time, the value of those options grow. So you're tying the value of those options to the future financial performance of the company, incentivizing your employees to, number one, stick around, and number two, continue to drive on those key KPIs that drive the value for your company.
The ultimate motivation alignment tool, isn't it?
Yes, absolutely. So then to get back to the initial question, well, then why do you need a valuation? And it has to do in part with managing your employees, demonstrating fairness, and demonstrating that you appreciate them and you give them the fair value for the options that they're being granted. And I'll use an example to sort of illustrate this point a bit better. Because I work with a tech company in town, great company, software as a service business. Similar for most tech companies, their first few years, they maybe raised some capital from friends and family, and then they used employee stock options to compensate their key developers, their key employees. All fine. We had an employee stock option plan in place. Startup company, low on cash. They didn't want to go get a formal valuation. Unfortunately, they used a web-based valuation that I'm not familiar with, and it turned out to not provide the best valuation number. So this company had issued all of their employees, key employees that were sort of foundational to building the business, at a strike price of $4. Okay. Fast forward a year and a half later, the company got a VC out of California to invest in the company. Excellent. Like, that's the exact kind of story that we want to hear in Calgary tech. So they called me. They said, we got to do this transaction. I said, great. We closed the transaction, and then it dawned on the team that the price that we had issued equity at was lower than the strike price in our stock options, and it was significantly lower. And the CEO felt, frankly, terrible, because the CEO had given their employee these options thinking that they would increase in value, and the options were priced at a strike price that was so high that we were going to have to 7x the value of the company in order for those employees to have any financial benefit for those options. CEO felt terrible. Employees found out. Employees were like, whoa, our compensation that we thought we were getting, we're not. Yeah. So it created some HR issues, some employee retention issues, so on and so forth. We can fix that, but the lawyers can fix that. But what we had to do in this particular circumstance, we needed shareholder approval to reprice those options. And we had just done a capital raise, so now we have a VC from San Francisco. We had a couple of VCs from Waterloo and Toronto area.
You got the original shareholders.
Yeah. So we had to call a shareholder meeting in compliance with the Act, give the 21 days notice, send out the meeting materials, all to reprice our options. Ultimately, the shareholders voted to approve the approval. I can tell you the CEO got grilled a little bit on the valuation and sort of why they were going through this. And it ended up costing the company, the cost of hosting a shareholder meeting, because they didn't get the valuation at the time of that initial grant.
Right. Yeah. And so, okay, you know what? Can I put this out to the floor then? Because there's been scenarios where we've had somebody set up an ESOP, and the approach is, we're just going to do a formulaic approach to valuing our strike price, our grant price, and our strike price, right? And it's going to be instead of having to pay Gord every year, I don't want to come up with the $5,000 a year or whatever it is to update your valuation, $7,000 a year. I'd rather not pay that, and therefore I will do a formulaic approach based on whatever I don't know, ChatGPT research yielded, right? And so is that legally effective, first of all, I guess?
Well, I want to talk about CRA risk, and I want to say this very gently. I hate to say it, but the level of training among a lot of the frontline auditors is not all that high.
Yeah.
And the CRA loves pieces of paper, and they love pieces of paper that are signed by someone that has the initials CBV. That when it's coming from the management or the business owners themselves, and especially if it doesn't look all that professional, it just might not hold water. Now, is it a foregone conclusion that you'll get audited? No. But can I advise based on playing the audit lottery? No.
Okay. So you're talking about tax risk specifically. And so I guess in an employee stock option plan, there is tax risk because there's benefits flying around, and so you're saying in order to be effective legally from a tax perspective, it ought to have a CBV valuation and not be formulaic from an ESOP perspective.
Right.
Okay. What about, Mark, from a securities law, sort of all the bizarre acts that you work in? Is that effective? Like, does that hang, or is it just a tax risk that we're talking about here?
I mean, even in securities law, when we're talking about risks of the valuation being deemed, because as Rob alluded to earlier, generally speaking, transfers are deemed to occur at fair market value. So even in the securities world, when you're issuing compensation, maybe in the form of equity to employees, if you issue those shares to your employees at a dollar, CRA can come back and say that's not the fair market value of those shares and reassess that grant. So even while I deal with the corporate side of things, it's still the CRA's assessment of value that often drives
I see
the repercussions. Yeah.
And then you've alluded to in that very sort of graphic detail of how things can go wrong when you get it wrong operationally and practically, right? So yeah, that's a real takeaway from this sort of ESOP discussion. I think we're at time, gentlemen. I want to thank you so much for making the time to come on and talk about valuations.
And Clay, we really appreciate coming on. I would just be remiss if I told people the benefits of an ESOP plan or employee stock option plan. All right. And Clay, one thing on employee stock option plans, employee equity plans, I'd be remiss if I didn't explain this to folks or at least highlight this potential risk, is that often companies, you issue your employees non-voting shares. Totally standard. I don't have any problem with that. However, lots of employee operators, owners of businesses operate on the assumption that those shares are always non-voting. And the corporate law in Alberta provides non-voting shareholders the right to vote in certain circumstances. So whenever you got an ESOP in place, you need to call Rob and I. You need to get a unanimous shareholders agreement in place.
Unanimous shareholders agreement.
Exactly. Those two things, if you have one, you must have the other. Because what you can effectively do is give your employees a veto power on certain actions where the law requires their approval, even if they hold non-voting shares. So if we're doing an equity plan, great. You got to have a USA to sort of back up and protect your business with that stock option plan or employee equity plan in place.
Yeah, and broadly speaking, how I like to think of a USA is sort of, for all intents and purposes, let's call it a partnership agreement. How do we interact and behave with each other? What happens if I want out? What happens if I want you out? What happens if somebody comes to me with an offer? What do we do about insurance? A lot of just operational, practical things are addressed in that. And I think it's really good to call out that even non-voting shareholders have a say, and they do have some things they can vote on. And so it's really important to define that relationship, and you define that relationship within a USA, right? Have I described? I'm pretending to be a lawyer. Do you like it?
Yeah, no, I love it. I love it.
Yeah.
Maybe just one quick horror story on that point is that.
Please.
So the legislation provides the concept of class votes in certain circumstances. And I had a company recently, they had 2 employee shareholders. These people are each holding, 2-3% of the total shares of the company, non-voting shares. The company went to sell for, legal reasons I won't get into. The law required that we have a class vote in place. So all of a sudden, this company, where we had these 2 employee shareholders holding less than 5%, they had a veto power on the sale. And as soon as they sort of recognized their leverage there, they had a few asks from management of the company in order to approve the sale in the form of a nice little sale bonus. So, that's fine. They negotiated themselves a bit of a golden parachute, but if they would have had a USA in place, management could have avoided that friction that popped up last minute and sort of caused a day or 2 delay ultimately in closing that transaction.
Yeah, right. Yeah.
Is there anything else that anybody wants to add to this before we wrap it up? Yeah, we could talk for a lot on that, but maybe just a bit of a teaser. If giving employees some voting control, even to Mark's point, even though they're non-voting shareholders, they might get a veto. If that scares you, other options would be a Section 7 trust or an employee ownership trust. So there's different structures that can get to that same type of result. And again, you got to know what the thing's worth. You got to get a valuation, but there's a few other ways to approach that. Sounds like Gord's going to be a really busy guy.
So thanks
Appreciate it.
everyone. Yeah, thanks everyone for making the time. Mark, Rob, Gord. It's really nice to have this kind of I guess a power panel here on valuations and why our clients need them and when they might start to think about them. It's been really enlightening. Thank you so much.
Our pleasure.
So Rob, Mark, go ahead. Sorry.
Thanks for having us.
Yeah, thank you. So Rob, Mark, tell us how we can get a hold of you, and we'll include your contact details in the footnotes as well, but tell us how we can get a hold of you.
Rob.
So again, we're at MLT Aikins. My number 403-693-4334. I won't try to spell my email address, but it'll be in the footnotes.
Yeah, right on.
Yeah, similarly, I'll give you my phone number, but if you plug Mark Mielke, MLT Aikins into Google, you'll probably find my firm profile. There you can get my phone number, my email address, add me on LinkedIn. Happy to connect with as many people as possible.
Yeah, fantastic. And Gord, as always, you can get a hold of at McFarlane transitionadvisors.ca or aikenhenderson.ca. Give me a call if you want to talk to any of these guys. I'd love to introduce you, and we'll see you next time.